In part two of what the market will do versus what you need it to do, we're going to get into some of those calls and, of course, what we should be doing with them. So last week, we really kind of touched on the setup of here we are at this time of year, so many people making predictions. What do we do with these? By design, that's why newspapers run them as huge headlines. They're emotionally provocative. They bring out our attention, grab us. And of course, when that happens, when those emotions start going, one of the common mistakes people make is, hey, if I'm feeling something, that means I should do something. But a lot of what people do proves to be counterproductive to where they actually want to go. And a lot of times we just need to set. But there are some places to reflect. As we touched on last week, get emotionally prepared. There is a use of them. This week we're going to go into some of our favorites. And as I talked about last week, they're not our favorites because we think they're going to be right. They're not our favorites because we think somebody's got that crystal ball. They're there because these people aren't trying to make a call. They're very much just trying to set the lay of the land about what could happen. What are the different drivers? What are the rubs that are going on within the economy, within the markets? Again, with the degree of humility, experience, and of course, insights that we've watched over time to be able to trust these people's opinions. One of our favorite commentators, as you know, is Brian Westbury, Chief Economist at First Trust, been an award-winning forecaster in his own right. What he really sets up or address, and this is all in last week's written commentary, as well as in full in this week's written commentary, is what has pushed off the recession? Coming off of 22, obviously a tough year for markets, but not one that really saw the recession that everyone was looking for. What's delayed that? And what he's called out was $2 trillion of deficit spending the last 2 years, as well as 50% of the employment coming from the government and healthcare sectors. And so, again, just a lot of government stimulus that, again, aided the economy. It's not necessarily a judgment, although his opinions are, I think, pretty clear on that. He would say, hey, that pushed off a lot of the pain. At the same time, you've seen interest rates bleed up. People, when they're looking at all the different assets that are out there, have to make a range of decisions. The more risk-free Treasury yields get up, hey, do I go there versus equities? And there's been a correlation historically between Treasury rates and forward-looking market returns. Plugging into his model, he would tell you the market is likely to drop this year. I'll let you read exactly how and to what degree, but his whole point is, hey, this is overvalued. Things have gone too far. They've done it on artificial stimulus. There needs to still be a reckoning. To us, that at least makes some sense. And again, for those people getting swept up in the euphoria of tech stocks and AI or Bitcoin or whatever the case may be, maybe those are a part of your portfolio, maybe they're not. But the point here is, again, to not let those emotions, let that greed, that excitement carry you away, and to remember, again, there are some things out there that could create stumbling blocks to risk assets. The team at Strategis had a little bit more constructive outlook, although they had the cautions of their own. They pointed to the strength in corporate profits, strength in the labor market, still tight credit spreads as being indicative of an economy that isn't on the verge of a recession at this time. However, they did call out expectations. They pointed to valuations. They pointed to the recent rally in risk assets as creating a pause. And we've talked about this time and time again. People will say, well, hey, if it's a good stock or if the economy's in a good place, then this should happen. It isn't just about good or bad. It's all about relative expectations. And again, the caution here is that, yeah, the economy looks pretty good, but expectations are very, very high based off valuations, the various narratives around risk assets. And that's, again, where a lot of people are saying, hey, we've seen this story before. Proceed with some caution. Don't be going all in to these risk assets here at what could be a near-term top. The prediction or summary of the markets that we really think is the most constructive to consider as investors came from Goldman Sachs. Brian Snyder, chief equity strategist at Goldman Sachs, came out, commented on Goldman's call prediction, if you will, that the S&P will only average 3% a year over the next decade. To put that in some context, the last decade saw the S&P averaged 13%, with a little bit of a caveat. And this is an important one that, again, we've been trying to call your attention to. In early December, we put out a commentary. There's a link in last week's written commentary, that it isn't that everything is worrisome or that there is no hope within the investment landscape. He focused specifically on the amount of concentration within the S&P 500 into those top 10 names and the current valuation that they're trading at as really the point of caution. So what does that mean to us as investors? Well, one, don't just blindly buy index without really knowing the underlying composition. And two, to look to other assets that, again, may have their day in the sun, but not be in those stories, those narratives that have been so in favor over the last couple years. To wrap it up, we look at this range of outcomes, some really true efficiencies within the markets, still strong earnings, a still relatively solid economy, juxtaposed against valuations, expectations, risk appetites that historically would be pretty worrisome. And what do we do with that? Well, again, as diversified investors, the takeaway is look for the opportunities. What are those assets, even within the equity space, that are trading at more attractive valuations? What other asset classes, particularly with interest rates having come up, can pay you a really healthy rate without necessarily taking on some of the risks that other assets may have with them? The difficulty really isn't finding these assets so much as it is having the discipline and the patience to do something that seems out of favor at the moment for what hopefully is a much better tomorrow. Thanks as always for watching.